Okay, good morning. Thursday, 13th of July. Let's take a recap of briefly of some of the moves from yesterday. We'll look at some of the overnight news and what to expect from the day ahead. And obviously Janet Yellen, the semi-annual testimony was the real highlight of yesterday's session and caused the biggest cross-asset reaction. That being, as you well know, a kind of dovish interpretation resulting in kind of I guess what you call a monetary policy play in the markets, i.e. US yields fell, so T-notes rallied, equities rallied, gold rallied, the dollar initially fell before then on FX it saw a little bit of volatility. But certainly in this new world of more hawkish central banks, something of which many were kind of intonating towards a coordinated type strategy from that central meeting we had in Portugal about 2 weeks ago, where kind of the major heads of the central banks, probably the exception of Japan, were all kind of sitting on the more hawkish side of policy hints. However, Janet Yellen did pretty much what we thought she'd do. She, in terms of, didn't really change up things too much, keeping a fairly similar tact to the June press conference. However, there were a few alterations that caught the market's attention, and one particularly that was in focus, as we know, and has been a particular area of the economy in the spotlight for Federal Reserve members, has been that of inflation. Now, Yellen kept a gradual rate hike outlook. That comment is very much now bedded into market expectations. We know interest rates are going to have to go higher from here going forward in terms of their strategy, now that they've hiked and have had subsequent hikes throughout the course of really this year. That's not really a shock to the market. What is, though, is the outlook as inflation puzzled the Fed. An actual comment here, if I read verbatim from the Fed chair, it will make a bit more sense. So to recap, she said, "I do believe part of the weakness in inflation reflects transitory factors, but well recognized that inflation has been running under our 2% objective, that there could be more going on there." She also said that there is uncertainty about how much inflation will respond to tightening resource utilization. Now, those comments in particular on inflation were very interesting because at the moment, if you look at, well, looking at this chart here will make probably a bit more sense, but if you look at the way that US inflation has been performing, it basically has been trending lower, certainly in things like CPI, which actually we're going to see tomorrow, the latest reading. But what the Fed have done is they've kind of talked that away, saying that actually once these temporary factors are removed, it will move back in towards and stabilize at target, meaning that we can continue to pursue our tightening policy, whether that's rates and balance sheet tightening. What they've also been suggesting is that unemployment rate at the moment in the US at 4.4% is currently tracking at a 16-year low. And what the Fed have been telling us is that as the labour market tightens, that should naturally then create inflationary conditions. Certainly in terms of wages, though, we haven't really been seeing that feed through, as the graphic here highlighting wage growth has been lukewarm while the labour demand has been robust. So if you look at the labour kind of curve, if you like, it's been falling fairly persistently, and yet wages have barely moved. And so starting to raise a few question marks about can the Fed remain confident about their idea that this tightening resource utilization, as they term it, will actually translate then into inflation going forward? Well, as far as we gathered then from what we heard from Yellen, they're getting a little bit less confident. That then is a very small but fairly clear change in communication to a slightly more dovish standpoint. The other thing that she said on the rate side was because the neutral rate is currently quite low by historical standards, the federal funds rate would not have to rise all that much further to get a neutral policy stance. So again, talking about the new norm that we live in, when I started in the markets in 2006, the new norm was interest rates 5%. That was the norm. I'd say now it's well below kind of that level. More like 2% is probably where their overall objective in the long run would probably be deemed as a neutral rate. So how has this played out? Well, we saw yesterday, I mean, just bringing the Dow onto the charts, we had record highs again in the Dow Jones. Just looking here on a daily continuation chart, you can see we're pretty much sitting right at that previous high point that was printed back on the 3rd of July. Obviously, we're close to it during the mid to late part of June, but the dovishness, or let's say, it's not that this communication is going to change what the Fed are doing. The Fed are still going to hike rates, in my opinion, this year. That still looks set to occur in December, and they're likely to still be talking about the commencement of the process of balance sheet tightening in September. The only difference here is about what do they do thereafter, and what's the communication to really soften the blow while they tighten. I can't remember, Ariane made a really good descriptive comment of it. It's kind of tightening packaged up in dovish commentary in terms of what the strategy is, it seems, from the Fed. So I think you can really expect that they'll continue to tighten, but albeit in an extremely cautious, slow manner that means that overall it's perceived to be fairly dovish. I think that's how the markets really took it yesterday. So the Dow hit fresh record highs. From looking at the S&P this morning, we finished higher on Wall Street last night. The S&P up 0.75%, the Dow up over half. The Nasdaq, again, tends to see either outperform, underperform. The Nasdaq was up 1.2%. But an interesting level just being tested already this morning, 24.45. So after that rally that was seen post Yellen, we've added to some of that move, and we're testing up at the June 29th highs here. Again, given what's occurred, I'd probably still be more favourable of looking technically in the aftermath of this to be long rather than short when it's coming to US equities. Just about identifying then a good entry point. The FX reaction has been a little bit more difficult to fathom. Certainly in the initial move on Yellen, it all kind of went as you would imagine, whereby the dollar weakened aggressively, and so euro-dollar spiked higher. That kind of made sense with the overall dovish interpretation. However, then it was actually the euro started weakening considerably, and the euro-dollar pair fell, reversing most of the gains that were seen at the beginning of the week. Now, wasn't really much behind that from a fundamental perspective, but I guess from a broader macro point of view, if the Fed are losing a little bit of confidence about the future path of inflation, then obviously this is something also that the likes of the ECB are banking on in order to get themselves more hawkish going forward. So whether or not this has had a bit of a read across into how other banks might react, but overall I would say don't want to read too much into that because we've already recovered some of that move overnight in the Asia Pac session. Coming back to pivot, quite an interesting level. Obviously that was the overnight Asia Pacific low. We're just having a little push on that level at the moment. There you go, it's just a little bit more momentum there. Probably the low that was seen yesterday afternoon amid the post-Yellen volatility probably looks like a decent level. I would say, just given what's happened, I think being long euro-dollar is probably my preference, but I'm probably more interested if it gets down to that lower point from yesterday's range. Looking at the actual dollar though, to put in a bit of context, this is looking at the dollar over the last year. So this is the dollar index. And obviously November, you can see here, this was the kind of catalyst when we rallied in the dollar very aggressively over really from the point of Trump winning the US election all the way up to the Christmas break. We saw a real shift in view about the the fiscal stimulus that Trump was promising and how that would convert into stronger US economic growth, higher inflationary conditions to be met then by a more aggressive tightening of policy from the Fed. And hence, the market repriced very quickly. However, obviously since then, as we know, various Trump U-turns, various scandals about relationships with the Russians, lack of implementation that has led to from more market sensitive kind of issues around the fiscal side has meant that dollars continue to weaken. And what we've had more recently here, quite a sharp dip in the dollar index, has been more about appreciation of the other currencies, euro rallying and the pound rallying on the back of more hawkish speak that we've had. And so here we are, we're at the lowest levels we've traded in the dollar now since September of 2016. So despite the fact that the Fed are still on track, if you like, to further increase rates, that has pretty much been built in to market expectations. Now it's about what happens thereafter. So this is very different to, say, the equity chart, where if I was to map the Dow Jones on the back of this, then you would have the same initiation point here of when Trump won the election, except what's happened is the two charts have gone inverse in regards to the Dow has gone to record high after record high after record high and remains up there. However, the dollar remains at around its lowest point, having more than reversed some of the Trump-inspired move. Quickly then on some of the other big factors from yesterday, oil prices saw some really quite choppy price action. We had the initial API spike. Obviously, it was the biggest drawdown since September 2016. Cushing, biggest drawdown since February 2014. Prices shot higher. Bullish report. Only then, we rallied pretty much about $1 at the point of when the DOEs came out. And as we were suggesting at the time, given the fact that statistically the drawdowns were so large in the APIs, probably going to be a bit of a struggle to get much more out of the upside of this price movement, because of the fact that you'd have to be extremely large drawdowns to outdo the APIs. That, as well with the fact that US rigs are back on the up, we're expecting US output to recommence its upward trend. So we had a little blip higher, found a little bit of resistance around that high that was printed on the 6th and around its respective R1, and then it took a few minutes and then we came crashing all the way back down to pivot on a full reversal of the initial move. So net neutral cancelled out the API inspired rally that we had had the 12 hours before the release. Where do we sit right now? Well, again, we've kind of taken aback that whole infantry inspired move. Really, if you look at it, net, we're only about 10 cents or so above all of the data from the infantry side having come out. And so I guess it's about reevaluating the fundamentals here. And probably the one that sticks out the most is, of course, the US output figure. US output yesterday was up 0.68%. That follows the previous week when it was up 1%. This means then that after that surprise decline we had about 3 weeks ago, we've now had two really strong increases in US output. And now at 9.397 million, that is the highest, as you can see here, year to date. Let's see if my chart will update a little bit longer range. You can see here, once we start getting up to not a great deal more, we would be at pretty much record levels that were last seen back in kind of mid kind of Q2 of 2015. And so US output still very solid at the moment, and that obviously has a negative read across into market prices. The other thing was they've talked about potentially an extraordinary OPEC meeting to happen on Monday. That's a week earlier than the technical meetings that are happening on the 24th, but no other details has really come out of that. In fact, they've tried to convey that this isn't like a snap decision meeting where they're going to make some real big groundbreaking announcement. I think it's just a case of they want to be discussing more about ongoing compliance issues and so on and so forth. So probably still more favoured with the short at the moment in crude. Obviously we haven't this morning, since Europe's come in, we've not got as high as the pivot level, but if we start getting up towards the highs that we're seeing from yesterday, amid some of the volatility on the data, 46, 48, that also being that high, as I said, on the 6th, maybe quite interesting to look at in terms of a short in crude. Going back to the central banks, Canada obviously raised rates, as you can see here. Rates in Canada now 0.75%. And that's the first interest rate rise we had for several years, obviously going back to 2010. How did the CAD react? Well, very sharp move. Now if I just bring in my dollar CAD chart, so moving lower, indicative of CAD strength, you can see here really strong move to the downside. Now when it comes to how might the market react to an interest rate hike, even though it was the consensus, this is when you need to look at the breakdown amid what is the split of the number of analysts surveyed as to, is it a complete across the board 100% all analysts looking for a hike, or is it a little bit more balanced? Because if it's more balanced, it means the market probably is more positioned 50-50, and so inevitably when you do get a hike, even though it might have been slightly the majority looking for that, you do get quite an aggressive move. They also, I think, hiked some of their GDP outlook. They said that they're going to be data dependent kind of going forward, but certainly they struck a more hawkish tone, and they obviously confirmed the fact that they hike rates. From a technical point of view, the break lower, you can see we broke a key support from a few days ago. The push lower puts us back down to levels in dollar CAD not really seen since, well, look, you're going back to summer of last year, pretty much a year ago. And then yesterday as well, with that breach, a couple of key levels there from historical sake from 2015, 2016. Obviously, next line here on the daily continuation, looking at 126.44. I've had a bit of a bounce off that after some of the downside pressure from yesterday, but then beyond there, obviously the bigger target then at 124.61 if we were going to continue to move lower. So pretty interesting for the CAD yesterday. If it continues to come back up here, obviously you've got pivot coming up, but a lot of CAD strength we're seeing. One of the things that I had put my way was a question yesterday about if Canada are hiking, if the Fed are hiking, does this mean that the other central banks will want to follow suit? Well, that probably could have made sense before we heard from Yellen, because you could have thought, well, it almost felt like those last couple of weeks that we were getting this kind of coordinated type commentary from the central banks. And what I'm showing you here is a chart between going back all the way to the early 90s. And we're looking at the Bank of Canada and the federal funds target rate, so the interest rate of the Fed. And what you can see is that they tend to map each other fairly closely. Now, although there is quite a close correlation between the two, I guess geographically and from trade terms, they are heavily reliant on one another in some respects. But I'd say that probably monetary policy globally from an interest rate perspective as a specific instrument tends to be fairly correlated. I mean, if you're looking at post-financial crisis and recovery, they probably all map slightly similar. But the point being is that Bloomberg are suggesting this kind of recoupling idea. Does this mean, though, that the Bank of England and the ECB will act? Well, I actually think no, I don't think they're going to take this into too much consideration. Probably the one thing that they won't want to happen is too much of a policy divergence to happen, i.e. one central bank being in a more hawkish phase, the other in ultra dovish. That just drives then currency kind of differentials even wider. Hence the reason why you might have had some of the more coordinated talk more recently. Okay, looking at the pound. And really I want to take you through a little bit of a journey of how the pound's reacted last couple of days, because We've had some new comments overnight from one of the hawkish members, McCafferty, but I think first of all you've got to start with this guy. Quite an appropriate picture. Pound drops as Ben Broadbent, who is the Deputy Governor of the Bank of England, says is not ready for a rate rise. So this was what we heard yesterday from Broadbent, and this was interesting because if we go back to the pound chart, this was when we rallied, when he didn't say anything. Oh, sorry, we fell when he didn't say anything. We've then had the confirmation where he then comes out and makes a dovish comment in the Wall Street Journal the very next morning. We sell off. We initially hit session lows, only then for the latest wage data to come out yesterday. Unemployment unexpectedly fell in the UK. If I remember rightly, unemployment's now at a 42-year low. And then the wage data ex bonus ticked up, and it was 0.1 higher than expected. And so the pound actually rallied on the back of that data. The real decision-making, though, problem that you have, and the reason why, before we actually look at this chart, let's have a look at the comments here from this chap. This is BoE McCafferty, and he gave an interview exclusively to the Times newspaper overnight. He said the Bank of England should consider unwinding its QE program earlier than planned. Now, he has said that current policy dictates not starting to reverse QE until interest rates are materially higher than present. So what he's suggesting then is, come on, let's get on with this rate rise. Let's get rates higher because we need to start winding down our QE program. So what you've got here is, if you were sitting in a boardroom having a conversation or a discussion about monetary policy, you'd basically have Broadbent sat one side and McCafferty sat the other. Two completely contrasting views. Now, this is the real difficulty that they have in this chart then, and although we had wages pick up a touch yesterday, the problem is that when you're looking at well, this graph showing you average weekly earnings, 3-month average growth in the whole economy year on year, and it's negative at the moment. We know that in terms of real wages turned negative a few months ago. But then you've got inflation, and UK CPI EU harmonised figure is tracking up towards 3%. As far as McCafferty is concerned, inflation in the UK is going to peak above 3%. Again, this is the real uncertainty that these policymakers don't know. They can only project and therefore base their opinions on for their decision making. Is where does inflation peak? And is part of this strategy to suddenly turn a little bit more split on the board to sound more hawkish rather than constantly dovish amid the Brexit and political uncertainty, a strategy to control the pound and keep it up around 130 to negate what was happening, which was the pound, if you remember, was down at 120 not so long ago, and that was fueling even worse this inflationary issue. But it's this divergence that we've seen really materialize over the last 6 months that's driving this complicated decision now that the MPC members will need to make. On top of this, you've also got Brexit, and one of the, again, we talked about yesterday the bit of a mess that we're in regards to Boris Johnson saying the exact opposite of the Brexit minister David Davis, while David Davis, who's started to sound a little bit more conciliatory with the talks with the EU, has now been ousted by his junior Brexit minister, who this morning said, "We will not pay a penny more than we need to for Brexit Peel." Not sure how conducive this is to helping the discussions about, as we know, the very important issue of settling the divorce bill first in order to lead to transitional and trade-related talks. Definitely the European strategy, certainly if I was a member of the EU, I would say, I am not going to speak to you until you pay your bill. And so comments like this are only wasting your own time. That's pretty much what I'd expect the European members to take a very similar stance to that. So, yeah, Brexit, I guess, has taken a bit of a sideline to monetary policy in the last week or so, given the fact we've got such divergent views within the MPC. But looking at the context, let's go back to intraday and how to look at this pound this morning. And we're at quite an interesting level here because we're at R1. We broke it earlier, but that R1 provides a pretty good floor here for potential for those looking for a long entry. When you think about it, although the problem is the dollar's recovered a little bit, but in more broader context, you've had a dovish Yellen, and now you've got a hawkish McCafferty. McCafferty is expected to be hawkish, so I'm not sure how much you can read into that, but certainly Yellen was more on the dovish side. So if anything, from a fundamental directional bias, you've got a potential further move to the upside. Entry here, you've got R1, as I said, with the 11th high, then with a push up looking back to R2, which would be around the 130 level, with the 6th and the kind of cluster of the price activity on the 7th high just above 130.06 as kind of a target. I guess otherwise you'd be looking more lower down at towards yesterday's low as another level of significance. So a couple of things to consider in terms of the sterling currency. It's been pretty seesaw price action. It's come to life the last couple of days. One other headline, just to wrap up the news perspective. You've had Chinese data overnight as a guideline. Asia, fairly positive session across the region, following on from the positive close on Wall Street post Yellen. China trade in June above expectations. So this is their trade balance, imports, exports. Beats expectations on robust demand, but headwinds are eyed. Now, when they talk about headwinds, they're talking about the fact that North Korea. Now, North Korea's gone a little bit quiet the last few days, but there's obviously a growing tension in the Korean peninsula, of which the US are pushing China to deal with the problem. If the US push too much, that disrupts then the relationship between the US and China. This could have negative effects for the Chinese trade in particular and their economy overall. And so that's what they're referring to when they talk about headwinds in the future. Albeit these are, on both sides, I'd imagine, likely to be managed to the benefit of both countries. So probably a smaller headwind, but one to be aware of. Okay, a look at the schedule for today. You've had the various European CPI numbers for June, but these are all final numbers, hence the reason why the market really hasn't had much of a reaction to it. But later, we had the OPEC monthly oil report. That came out yesterday. That was completely non-market moving. Now, that doesn't mean that I would disregard the IEA's oil market report coming out. Well, I mean, I've not seen anything as yet. It should be out any time around now. I would definitely keep an ear out for that when it does come out. Otherwise, looking into the afternoon, now, what makes Janet Yellen's comments so relevant in regards to the time is that she really identified this idea about growing potentially less confident about the future path of inflation. Now, the timing is key because today, of course, we get the PPI numbers, and tomorrow we get the CPI numbers. Now, these inflation measures are going to be really important then for trying to see what if this slight decreasing of inflationary pressures we've had in the US is a sustainable trend that is ultimately going to have to force the Fed to change tact, or do we start to see it level off, which is probably what the Fed would want to see in order to be able to stick to their projections of being able to tighten policy going forward. So PPI this afternoon, that will be important. That's at 1:30. That comes alongside the jobless claims, which I say are lesser significant given the focus on the PPIs. Later you've got the nat gas change figure, and then you've got speakers-wise Janet Yellen. Now, Yellen speaks to the Senate today, but for those who've never gone through a semi-annual testimony kind of procedure, basically she just repeats exactly what she said the day before to the House, to the Senate. So it's not a market mover. But you do have some other speakers to be aware of. Fed's Evans, voter, leaning dove, speaking specifically on monetary policy. So you remember this kind of tactics that gets adopted by the central bankers. If you give a big speech one day, you purposefully schedule other key members of your FOMC to speak the next days. If the market takes this move like it did yesterday and it reacted more dovishly, if that's what the Fed wanted to convey, then we should see Evans just toe the line. If Yellen feels like, oh, actually, I think the market's taken this a bit too much, I didn't really, we still are going to tighten policy, and really I think the market's made a bit of a mountain out of a molehill on this inflation issue, then maybe Evans gets used as that pawn to recommunicate the guidelines to the market. So definitely I'd be looking out for Evans. That's at the cash close in Europe, so 4:30, because it's speaking specifically on monetary policy. Then later, 6 o'clock for those still in the market at that time, Fed's Brainard. I'd say she's probably lesser important because she spoke about a day or so ago, and she was pretty much in fitting with her change of view in the last couple of months, and that she also agrees that we need to start tightening the balance sheet. Okay, that's your morning briefing, so going to leave it at that, let you get on with it. I'd say from a scheduled point of view, pretty quiet for the morning, but as was the case yesterday, I'd be expecting the main bulk of the price action to occur once North American participants come into the marketplace. Okay, have a very good day. I'll see you in the chat room. Thank you.